Good turnaround Tuesday, everybody. How are you? Hugo, Brock, Amit, Shahab, Royal, good morning to you, and Kevin. Yeah, Mira, at this time of the day, that's too much for me to. The capital gains increase, what will it do to the market? I don't know. Maybe the Fed will offset that. Anyway, we had a pretty interesting night. Stop hunts all over the place. Had one here in Cable, right? Took out prior lows with a spike. Tough to catch when you're in the US and you're asleep, but this is a potential turnaround Tuesday trade. I think you could risk this low now. The reason I'm saying pound over euro is because I think EG did the same thing up here. You would probably risk these highs, and if EG rolls over, I think we could see this level, 61.8. Otherwise, we start taking out these highs, we're going for new highs. But why can't we have this from here? That could take you down to 90.20 or so before there's another rally. I would actually be a buyer down here. And then maybe we get something like this from these levels here. Even in the dollar, I mean, we went right to a breakout again. And actually really came off quite a bit. Check it out. So what did we get up to here? Not quite 94, 93.89, coming off, trying to rally again. Looks like it might be a 2 drive. Yeah. 1, 2, maybe there's going to be an attempt at a 3 up here. But something I've had a little bit of a change of heart on, and I'm looking to be long, is I know that there'll probably be some disagreement here, but I'm looking at US dollar yen that really started diverging quite a bit. And this was another stop hunt, wasn't it? Right, took out this low yesterday before the recovery. Just curious what the off numbers all the way up here around 106. But if you just look at the formation that we have here, what do I have it on? Yeah. All right. So this was the spike we had yesterday. And now it looks like we're getting some kind of flag off this. You know, it'll look more dramatic on, say, a 15-minute. See? And then if we get through this 104.90 level, we have a chance for 105.80, which is going to take you back, you know, back to the triangle breakdown and the moving average up here. So I think we could go with this. This would be my turnaround Tuesday candidate, and you just have to risk yesterday's lows under 104, give it about 30 pips tolerance. If you want to get anal about a entry, you know, and maybe 30, 40. To me, what's 10 pips mean, especially if it turns out to be major, and I'm looking for 130 pips. What's the difference, really? You put a piece on, and then if you still like it at 420, 430, you put another piece on. So I think that we're having a little change. It's been all one way, right? All one way. And I think that we're putting in some type of low. So this is my turnaround Tuesday candidate. Let's see what's going on here. Great to see some dollar strength consolidating. One more low, Jess thinks, after this pullback. Okay, you would fade it. Okay, that's fine. I think it might turn good. It'll turn good up there. And Jess is looking for one more pullback maybe we're going to 3,200 here. You know, this line's been here for a while, and this line intersects. Let's look at some, yeah, I could see it based on RSI work, not, you know, no tremendous divergence. It's under 30, so very possible. How about the 1 hour? Same thing. So maybe we are headed towards this blue line here. So 3,200, you know, about 80 handles from here. And perhaps we'll have some type of divergence down there. We'll see. And oil tried to pop. And everyone knows, you know, most of us here in Forex Analytics, from my memory, were talking about the potential of a gold breakdown. We've rallied right back to it. Silver was my turnaround Tuesday call last week, which, you know, worked pretty good. It was, you know, this rising wedge that we had. I think it was at 27.5. I think it was this one, and then showed this wedge. So also the trade selection was good too. If you shorted metals, it was supposed to be silver based upon this turning. And I'd say that's a pretty nice turn that we had in the gold silver ratio, don't you think? You know, if you're outside the US, you can trade this as a CFD. So I don't believe that this correction is over. I mean, it was such a massive move from 120 to 70, call it 50. So even call it 70. So 25 is going to take it up here towards 94, 95. So what this means is when you're bullish metals, you buy gold. And when you're bearish metals, you sell silver. Because I think that this is going to have some continuation up to about the 50% level. Then you could start thinking about, and that might be a good time to start looking at the long side of silver again. So those are my thoughts. And they're, you know, what's important also are the thoughts of one of the best teams on the net. And here they are. Let's move you guys out of the way. Blaker's up 1% on Euro Yen short. Greg is up 0.76 on Aussie short. Blaker's up 1.15% on the long Canada position, and really cleaned up on Kiwi Yen, up 1.72. So if you remember, you would have known that when he pushed out these alerts. Okay, so was a good week to be a subscriber, and it's always a good week. And it's a good week to be a subscriber, really, especially up, you know, for the next few days. You know why, right? Because of the offer. Okay. And then you just have one more homework assignment. I think there's about 50 seats left going into the weekend for this. Ooh, Peter he looks bad. Mark looks happy. Bitcoin must have gone up. Abigail, beautiful. Pomp, not easy to get Pomp. It's got hundreds of thousands of subscribers. I've interviewed Daniel before. Interesting choice. And Jack Schwager's going to be there. He has a new book out. I'm going to be interviewing Jack. I'm trying to get through his PDF of the new book that'll be released in October. So it's going to be a great event. It's going to start Friday, last all weekend. So here you go. Here's your sign up. Register free. One of the internet's favorite words is free. And with that being said, I'm going to TO it to Blake.
Hey, Coach, can you hear me?
Your mic is loud and clear.
All right. Good morning. How are you?
Good morning. Good morning.
Hey, you know, it's been like a little bit of a consolidation ahead of well, after yesterday's move. Yesterday we had some pretty good moves in the market, and today it's Tuesday, so it could be turnaround Tuesday, right? Which would mean that actually equities might bounce if that's the case. But we're just kind of consolidating here. I think there's some fairly big developments in the markets right now. But what I got to do is I got to pull up the bias chart. I totally forgot to pull this up this morning. Now, before I go into all the charts and all the analysis, Dale was mentioning the Trader Summit. Make sure you guys get signed up. Obviously, you know, I was just looking at the page. It had been updated. It looks really good, by the way. The development team has done a great job, and the design team putting this all together. So if you guys haven't signed up, make sure you do so. You know, you were just talking about Jack Schwager.
Yeah.
You know, that was the very, well, him, that was that Market Wizards, the original Market Wizards, was my
classic. Yeah.
It was a classic. And in 1996 or so, that is when I first read the original Market Wizards. Then the next one was the Mark Douglas Disciplined Trader. I'm sorry.
Oh, okay. Oh yeah, he also wrote that book, Trading in the Zone.
Trading in the Zone was his newer book. The Disciplined Trader was like his one from pre-2000, and that was like the first book that I read. Unfortunately, Mark Douglas passed away, which is a shame because he I moved back home to Phoenix about, I don't know, 8 or 9 years ago. And when I moved back to town, he lived here in Scottsdale as well, just pretty close to where I live. And we were planned on getting together for lunch at some point, and then he passed away. And it was more of my fault. I just kind of was lollygagging around, like, oh yeah, we should get together for lunch type of thing. And then unfortunately he, passed away. So it was anyway. But he was another author that I read a lot of, and obviously read his books. But Jack Schwager, man, I'll tell you, the original Market Wizards book is probably my favorite. And I know he's putting together a new one right now, so it's cool.
Blake, but I asked Jack in the first interview. I always think, people have agendas and stuff. I said, Jack, was your real incentive and motivation for writing this book to learn how to be a better trader and learn some things from these gurus that you interviewed? And he said yes, and it turned into a book. So, he was trying to jack trades. So he figured, I could become a great trader if I can connect with the wizards. Yeah. And that's something. It wasn't just as a journalist, where you're writing about traders. He was a trader and wanted to become a better trader. Why not talk to the legends, find out how they did it,
It's yeah. I mean, if you even go back, and this is the one that the original Market Wizards from 1989 right here. If you read that book, a lot, it's interesting. The times are different, but the same trading psychology, the ups and downs that traders experienced back then are the same experiences that you deal with today. We all deal with the same emotional roller coasters, and dealing with risk management, yada yada yada. It's nothing changes. So it's still a great read, even all these years later. So anyway, guys, you have to, I know probably 90% of you have already registered, but make sure you do so. What you probably haven't done is this tweet right here. I'm going to go ahead and copy link to that tweet. That tweet right there is the one that, you could do another one too, but retweet this and then respond back to that Twitter handle that you want to be part of the giveaway. That's all you have to do. And follow Forex Analytics too. Retweet that. Say you want to be part of the giveaway. You got to respond back to Forex Analytics. And remember, we're giving three months free. So to 3 different traders, we're giving you guys 3 months free. And we're going to send you some gear, Forex Analytics gear too, on top of that. So that is probably something a lot of you haven't done yet. So make sure you do so. All right. And that is to take advantage of the new offer that we have, which is a very generous. Let's just put it that way. It's a very generous offer because, you know, you guys lock yourself in.
Because we're generous.
Yeah. I mean, you get a good price. All right. So let's talk about where we're at with currencies. So the euro is bleeding lower. Now, I'm going to just say this. Okay. Let's think about like the last 6 months or, you know, since COVID lockdown, right? The Fed, every central bank provides massive amounts of liquidity. We get this, you know, reflationary type of environment. Stocks go higher, yields go down, precious metals rise, dollar slumps, right? I mean, you sell dollars and you deploy dollars, and everything else under the sun as stocks go from 2,200 in the S&P or whatever it was to 3,500. So 2,200 to 3,500, the big reflationary trade. Okay, so now that we're heading into an election, we have risks of COVID lockdown again into the fall. Look at Johnson. Prime Minister Johnson in the UK. He's talking about new restrictions because of the virus, locking down restaurants at 10, or I didn't read it all, but I saw that, there's new restrictions happening in the UK, but think about that happening globally. So, and then you got an election coming up, you've had this massive rally in risk. So think about it from just a very simple standpoint. All these dollars have been deployed into the markets for the last several months. You're going to see a little bit of a pullback. So if you get a little bit of a pullback, what does the dollar do? The dollar is going to bounce, right? If the dollar has been used to deploy, to invest over the last several months, we've got this big sell-off in the dollar. It's likely that we're going to bounce here for the next month as we go into the election. It's just, you're taking some of that back. It's like, I've had a nice profitable trade. Okay, let's take some off the table. You're going to have some of this unwind. So if you're wondering why the dollar, just in a very simple term, why the dollar's rallying, that's probably the reason why. There are going to be certain things that happen that might influence a specific currency to move a little bit more than the other. But, in general terms, we're seeing the dollar bounce. And that's why you're seeing, the euro dollar pull back. And like I said, the euro trading down to 116, 115. I know I've said this for the last couple of weeks. It's not going to surprise me. Am I going to be a buyer of the euro down there? Yeah, I am. I'm going to figure out a place down here, whether it's 116 or 115, to be a buyer of the euro. But, I do think we're eventually going to drift lower. Is it going to be an easy trade? Probably not. That's why I'm not trading the euro to the short side. But, it's, making its way lower. So today, support is going to be at this 117 level. It is very, very critical support. Yesterday, we found support right here at 117.30. 117 is very key support. Any rally overnight, excuse me, any rally, well, overnight was really capped at 1775. I would think that any rally back to 118 is going to find some sellers now. We can find our way back up there today, which is possible. Okay. And even though it's a range, I'm borderline about ready to go bearish, but we have to get below 117 to turn bearish. But you can see we're just, struggling up there. Cable. So if you guys did not see, now let's go to Forex Analytics. Let's go to pound dollar, basic technical analysis, end of day analysis yesterday. The 200 DMA will act as major support, which comes in below the lows from today and 2 weeks ago. 127 key is for the bulls to hold on any dips. Now 129 should offer resistance overnight.
Yep.
We hit the 200-day moving average
And 20.
and bounced like a bat out of hell today. So if again, if you're a Forex Analytics subscriber, you're like, oh, look, we hit the 200-day moving average. Boom, it bounced 150 pips. Now, obviously, as we approach 129, well, we got about 20 pips away. We found, resistance. So, if you're a Forex Analytics subscriber, you already, are well aware of what's happening here. So 127 is key support. It's the 200-day moving average. It's really critical. Resistance now, well, we can just mark up these highs since I don't know if we're going to make it all the way back to 129 now. So 128.70. I shorted it earlier this morning while we were in the chat room, and I only took 13 pips like a doofus. 28.70, and I could have made 60, but 70, 60. Smart. That's how good I am. I'm half asleep. All right, Aussie. So the Aussie's trading a little heavier. Some comments from the RBA last night. Now, I think they were taken a little out of context, but the RBA last night was, discussing about was it negative rates? I have to go back and check my notes. But anyway, some comments that weighed on the Aussie in Asian trade. We slipped from basically right here from 72.25, I think is when the headline came out. Slipped below 72 cents. Bounce.
Sorry to interrupt. They basically mentioned the possibility of currency intervention.
Intervention, that was it.
Yes,
Thank you
yes.
very much. Yes,
No
yes. DeBell talked about intervention. That was it. I couldn't remember if it was negative rates. I was like in the middle of dealing with my kids, and I saw it on Bloomberg, and I passed the headline around, and but it slipped. Thank you, Stelios. Anyway, the Aussie, I think we have to be very, very careful if we break this channel right here. All right, that channel support comes in at 71.60 today. And that's really important. And knowing that the market is pretty long Aussie dollars, we have to keep that in mind as we approach the support, because I think if we break that support, we should see, a quick 100 pip drop in the Aussie, in my opinion. Okay. Resistance for the Aussie comes in at, well, you can see these spike highs. I would give it all the way back up towards 72.50. I think if we reach for 72.50, that'd be more of a gift than anything. Let's go over to the Kiwi. Kiwi, very similar to the Aussie. It was the chart of the day yesterday. If you follow the blog that I write, this is a double top. Support will come in here at 66 cents, a break below 66 cents. Now, this is what I was alluding to in the blog, but this is pretty simple stuff here. Double top extension. There's your neckline. That takes us to 64 cents. The problem with that is it takes us to new lows, breaks us through this channel, all sorts of stuff. So there's a lot of implications should we break 66 cents. So that's Kiwi support. Resistance for today would be probably the highs, I would think, because you can see all this resistance here. There's the highs, so that's going to come in at 66.90.
Be back in a minute, Blake.
Okay, cool. 66.90. So we're still in a range, but threatening to turn bearish with that. Dollar Canadian. You know, we have the inverted head and shoulder patterns in play. It is bullish, guys. I'm long the dollar Canadian pretty aggressively too. So the breakout is at 132.60. That is support today. Okay. First target really is going to be right here, which is 133.80.90, which is 95, which is the 24% retracement. This is 133.15. We're basically trading at it right now. We'll probably mark up the overnight highs, which comes in at 133.45. Then after that, it's 133.95. So. And I'm going to tell you this, if you can get a dip right now, if you can get a dip down to 133.60, this is, in my opinion, this is going to be the best place to buy the Canadian. I just don't know if we're going to make our way down there. But that's where you want to be long. Okay. Dollar Mex. So the dollar Mexican peso, we are approaching channel resistance once again. 200-day moving average actually capped the rally yesterday. The 200-day moving average acted as resistance today. If you go to the end of week analysis, the US dollar Mexican peso is pound support, blah, 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 blah. The 200-day moving average at 2160 is the first logical area of resistance. I mean, I don't know how much more we can actually mention it on Forex Analytics. So you hit 2160. This is before the weekend. On Friday of last week, we tell you that 2160 is the first logical area of resistance. You hit 2160 and you reverse, right? So I mean, but the fact of the matter is that is really key now. So what that means is if we break above 2165, is gone. Okay. We have turned from bearish to range because now that break back or the break below the 21 level should be viewed as a false breakdown now. Okay, so support now should be at any dip back down to 2120 basically. So if we see a dip from here, so think about like something that looks like this, something like that. Okay. If you get lucky enough to get a move down to 2120, it's probably a better place to be on the long side. Dollar Swiss. Nothing's changed here with the dollar Swiss. Same analysis, right? 90.5, 92. While we're below 92.50, you have to stay bearish. As I mentioned yesterday, the problem with the Swissy is that it could be very similar to the yen. It could act a lot like the yen, which we'll talk about here in just a second on the yen. But for right now, this is bearish. And meaning if we get some risk aversion, the Swiss franc may come into, may be more in demand, right? Dollar yen. Speaking of the yen, so the yen, very frustrating to me yesterday because I was short dollar yen yesterday, and I had a very profitable trade turn into a flat. Basically, is what boiled down to. I was sitting in this trade, from this triangle, and shorting a lot of the other yen pairs too, which has helped. Which I'm still short some of the yen pairs, the Kiwi yen, Euro yen, but I was short some dollar yen, still had some left over. Nice profitable trade from this triangle. I took a lot of it off the table, but I still short some, hoping that we get a move, through this triangle, through the support, through 104 down to 103.50. Well, yesterday we did a little false breakdown, and then I don't know what happened. A lot of the guys in the office thought that was driven through futures, kind of mask the yen selling. It basically is like not intervention, but more of manipulation. I think is a better word to look at it. Anyway, that spike there really irritated the heck out of me, and I'm
Did
sure
you see? Did you see, Blake, that it took out that important low from a few months ago before it turned?
Oh yeah, I mean it took out the 104 level, and
yeah, that one.
No, and I was short. So,
Yeah.
But as it was trading back in the 20s, I was like, okay, we're probably going to find some resistance here at the 30s, and maybe make another run at the low.
That was a great ride from that breakdown, bro.
It was. I mean, look,
No
I can't
heat.
complain.
No
I
heat.
can't No, it was an easy ride up until this very end yesterday.
Yeah.
And it just zapped the rest of my profits, what I had remaining. But at the same time, I look at it as it looked like more of intervention. I was telling everybody as you were gone, it looked more like not intervention. It looked like it was like a futures move. Like, if you want to influence the market, you can go into the futures market and you could buy a crap ton of yen futures, or you can buy a crap ton of S&P futures, or sell or whatever, and influence the market a little bit. And I think that's what happened yesterday. Anyway, the office, we were talking a little bit about that. Regardless, it spiked it up, and now I'm leaving the dollar yen alone. I don't really know what to do with it at this point. We might have like an inverted head and shoulder pattern with this false breakdown, but really resistance is at 104.90. Support being, we'll just take the lows from today at 104.40, and then I'll write 104. Okay. And we're just going to keep that in range now. We were bearish, but we're just going to keep it in range since we're holding the 104 level. Let me get through this all really quick, and I'll pass it over to the guys. So dollar index, 94 is obviously very key. Any dip down towards 93 should be supported. You can see that as the little minor breakout point here. So, right? 94 is key. We're in a range, but a break above 94 will go bullish. So just remember that. It's key. US dollar, Norwegian krona, hell of a squeeze here, and it's holding. So now any dip to 920 should be viewed as a buying opportunity. And you can see the 618 comes into play right here at 938. So 920 938. Now, if you guys have been with me for the last, let's just say the last 2 months, what you guys have probably seen over the last couple months is really the bias chart flip from dollar bearish to range. Now you're starting to see the dollar turn bullish against certain currencies. So you could see the dynamic of how the market changes and how those trends have changed over the course of the last couple of months. And if you go and you look at every bias chart, if you save them all, which I don't, I just saved the previous day, but I'm sure some of you guys do, you can see how it flips, over time. Okay. What was I going to do? Oh, gold and then the S&P. Let's do the S&P first. So the S&P, we are now, we're below 3,300. And so right now resistance should be 33 on any rally, should be 33.17 right here. Yeah, you know what? Let's write 33.20. Okay. We have to go bearish on the S&P now that we're below 3,300. Okay. I know we're positive at the moment, but this has done the technical damage, I think. So, and we could flip back to neutral tomorrow, but I do think that we have to go now bearish. All right, so the 88% retracement of this move held, which is at 33 and a 32.25 basically. That's your next support. We break through that, then we should that should take us back towards the 200-day moving average, right? So I know we're positive right now, but it's early in the day. Let's go over to gold. Gold, as you guys probably saw, broke through this support, took out all the stops below 1900, and we're still trading pretty heavy. So now 1880. This is very similar to the S&P. Now that we've broken through that support, the technical damage is done. So now you probably need to look for rallies to sell into, like this. Oops. Right? So 1920 should offer resistance. All right, there's your bias chart. It's finished. So there you go. And I'm sure Steve and Stelios are here. Good morning, guys.
Good morning.
Good morning.
How you guys doing?
Good.
Yeah,
pretty big bout of volatility yesterday. It looks like today we're just kind of wrapping our minds around everything that happened. How do you guys feel about the price action from yesterday?
Well, personally, we talked about it on the webinar. I think there's a lot of things that can conspire to bring a broad risk-off move, and we're seeing some of them at least. COVID, you talked about lockdowns in the UK. They're considering doing partial lockdowns here in Greece, and I'm sure other countries. You have tech stocks which are starting to struggle a little bit. All these things together, we're getting closer to the US elections. We have the uncertainty of the appointment of a new what's the position called? Ginsburg's
Justice?
Yes, yeah, exactly.
Yeah, Supreme Court Justice, yeah.
So you have all these things which I think will probably be the trigger. And we've been saying this for days and weeks. There's going to be a trigger for a risk-off leg for sure. I don't get.
So if I was Donald Trump, this is what I would say. I would basically use that as an incentive to get Republicans and conservatives to vote for him. I would say, we're gonna respect the wishes of blah 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 blah, like of all the Democrats, and we're not and Ginsburg, and we're not gonna replace your seat until after the election. But if you guys want that seat, then you got to vote for me. So if you really want to stir up the conservative base for in America, you hold hostage the Supreme Court seat, and you say, hey, vote for me, and we'll get it done. If I was Donald Trump, that would be my plan.
I have a counter argument.
All I could say is, Blake, thank God you're not.
Thank God I'm not.
I'd have because you would be saying to all of us, be afraid, be very afraid, and you'd fire. We all would have been fired by now.
Right, that's true.
Especially me.
Blake,
especially you.
Blake, there is a counter argument to that. I think there might be a lot of Republicans that would get pissed that a Republican government didn't take advantage.
Well, yeah, that's the flip side. I'm sure that there's more to it than that. But if because the Republican, there's probably a lot of Republicans are like, we have to take the seat because you're not going to get reelected, and so but there's a lot to it. I'm being very simpleton this morning. You get it? Like, I mean,
I get the argument as well. I do get it.
It's like the same thing with my analysis on the markets. It's like, okay, we've rallied quite a bit. We've sold dollars to buy everything under the sun. So now that the stock market's pulling back, and we're probably going to go back to the 200-day moving average pre-election over the course of the next couple of weeks, we're going to drift down here. What's the likely path of the dollar recovery? As simple as it is, it doesn't mean the euro is going to go straight to 116 today, and it doesn't mean that the cable is going to go right down to 125 today, or the dollar Canadian's going right back to 137 today. No, it doesn't mean any of that. But what it means is we're probably going to drift down here in equities, and you're going to see the dollar recover a little bit in the most simplest terms. So anyway, that's just kind of my view on the markets, but also my view on politics, which thank God I'm not a politician. Anyway, guys, I'm going to turn it over to you. Remember, if you guys haven't done so already, make sure you retweet that tweet on the giveaway. So this way you can even if you're a Forex Analytics subscriber right now, if you retweet it and you win, you get 3 months added to your subscription. All right. So, and then plus you get some cool gear. Steve, I'm not sending you a new shirt.
I still have plenty. So
oh, you do?
I do.
Tell us you're not getting any more.
Thank you.
If he's a good boy, I'm going to give him from mine.
There you go. Who would want your smelly shirts? Anyway, and make sure you guys get signed up for the Trader Summit event. All right, I'm out of here.
Order more, Blake.
Order more? No, they're so expensive.
For us.
They're so expensive, Dale.
All right. Well, order a few.
All right. See you guys.
Bye-bye.
All right.
Thanks.
Hey, guys.
Hey, Dale.
Hey, Dale.
Steve.
Hey.
Hey, Sel.
Turnaround Tuesday today. Will it be? Well, after yesterday's move, it was a hell of a move, and not just in equities. I mean, you saw metals. Silver was down 8%.
Silver especially, yeah.
10% in a day.
I just feel so good for having unloaded the bulk of my long. And I'm now waiting. I've said this again, day in, day out. I say this, 21 to 22 is where I'm going to start loading up again, depending on price.
I'll tell you something. If we see 21, I'm buying you dinner because it's going to be one hell of an opportunity.
Well, let's see.
Well, Stell, I think you should think about what your favorite restaurant is. I think you'll get it. Maybe
I'm going to be more than happy to have to buy him because dinner. First of all, because we like to hang around together. But second of all, because
no, we don't.
I think. Oh yeah. I forgot. I don't like you. Neither your wife. I think it's going to be an amazing opportunity to be able to load silver at that price.
Yeah.
At least from a personal perspective.
Well, I think the price action, I was looking at the weekly chart. I posted it on the chat room this morning, I actually tweeted it as well. It's amazing how these zones work so nicely. And sometimes when you get a little bit of a throwover, like there was a zone around 26 and a half dollars, and it just went over within, a couple of days or 2-3 days, whatever it was. It had huge momentum, and then it just snapped back. And that for me just confirms, I think we're going to go to the zone below, which I think is around 21 or whatever it was. And but it's gonna depend on the severity of the move, how we get there. I'm either gonna get long very quickly or very slowly, depending on how it goes. But
I like that level, because most people, when they look at their weekly chart right now, Steve and Stell, would be waiting for a test of the breakout at 19. And it should never give them a chance to buy it there.
Yeah, I think looking for 19 is pushing your luck.
That's why I think 21's a good number. It's above where everyone wants to buy it.
Yeah.
You know what I mean?
And something, to be honest, let's consider the worst case scenario. Let's say that, this jump higher in silver proves to be like another short-lived rally, although you can clearly see the difference with anything we've had in the past, right? In the past, I mean, since we actually topped out at 50 the previous time. But let's assume that despite all that, that was like a one-off jump higher, and silver decides to move lower through 19 again, and then spend again a period consolidating in lower levels. Even if I've bought silver anywhere in the vicinity of $19, I'm talking about physical, of course. I'm just not going to bother about it. I mean, I will have absolute certainty that given time, silver is going to be, way higher. So I'll have no problem locking it in a safe and, just waiting. I'll be fine with that.
I agree with you 100%. And the similar case with gold, we talked about 1910 or 1920 was the previous highs, the previous all-time highs. We dropped below. We're now testing or going to retest them again. I think when we reject that and we go lower, I think we're going to go quite a bit lower. So, 1750.
Yeah,
I think we might get there. This is really not unlikely, and it will obviously depend what happens in the global environment. But if we get anything near what we had in March in terms of COVID and all that's associated with that, then I think metals can move quite a bit more quickly. But having said that, I think equities should correct a bit more. How much lower? I've been saying 2,700 in the S&P for a while. People think I'm crazy, but I think it's doable, there or thereabouts. And as with silver and gold, I'm going to be looking to get long because, let's face it, we have inflation. And I'm not talking about CPI. I'm talking about money supply inflation. And that's exponential.
Give it a little bit of time. And with what they'll start doing at a bigger extent, meaning universal basic income, etc., which is not throwing money at the top, which mostly affects asset prices. I think that we're going to see actual CPI explosion higher as well.
Yeah, I don't think they're going to let it explode higher. They're probably going to tinker with it again. But I think you're right. I think you're right. We will see higher levels for sure, because life as we know it is becoming more expensive. End of story. Healthcare, education, food, energy, everything.
I don't know if you've noticed, and we're not even in the US, but we've noticed with Katerina, there's a big jump in supermarket bills.
Of course. Yep. Supermarket bills. My medical insurance goes up every year. School
Your
fee.
medical insurance goes up every year because you're a
I'm
very
getting
old
older.
guy.
Yeah, that's true. But anyway, let's see what happens. Data-wise, we had very little. Swedish interest rate decision kept rates at 0. Remember, they spent a while at -3/4. They realized that negative rates don't help, and they're now standing firm at 0%. We have... Yep, go on.
No. Okay, I just wanted to talk about Sweden. I mean, first of all, I don't understand why they even bothered testing something that has been tested multiple times. But at least they recognize the mistake. And now
Yeah.
you see so many other central banks are discussing the possibility. I mean, we've had so much data that conclusively show that there is no benefit. I mean, the incremental benefits are far smaller than the negative side effects, and still we're here, discussing negative rates. I don't get it.
Yeah, that's the only thing they know how to do, central banks. So anyway, at least the Swedes said we've done a mistake and they went back to zero. Chairman Powell is testifying over the next couple of days, and I think is it to Congress? It's the House of Representatives. I don't remember, but anyway, he's testifying. He's going to be questioned, and I'm sure
I think that used to be Humphrey Hawkins' day, and
is it okay?
yeah, but they don't call it that anymore.
Well, he's gonna be questioned on a lot of things, and I'm sure the economic stimulus side is going to be a part of it. So
he's going to push.
Yeah, I think so. But otherwise, a pretty quiet day. We have some numbers coming up, but really nothing to write home about. And
Ziggy said condoms are increasing in price.
Well, I don't need one.
The only thing is that's good. Ziggy doesn't either. Ziggy doesn't. He makes water balloons out of them.
Stelios and Ziggy are now focusing more on the adult diaper prices.
Exactly. Yes. Anyway, yeah. That's so. On that note, that's it from me, my friend.
We took a left turn. All right. So, Steve, I'm here if you need me to read you the questions.
Yeah, absolutely. Let's go.
I
really
don't want
fast.
you getting mad at me anymore.
Through no, not at all. So let's go very fast through some things, and then we can go through questions. By the way, since they just mentioned the SEC, so far the recent rebound in the SEC, doesn't really show anything more than a correction over time. So in my opinion, I'm not saying we're going to top out exactly here, but in my opinion, any extension higher would not take long to find resistance. 905, 920 areas of interest. I do believe that whatever rebound we get here is going to be short-lived. USD NOK, we talked about it yesterday, so not much to say. Watch 945 as the next area of resistance, but this might unfold to be just a corrective rebound. Keep in mind that the 200 DMA is also at 950, so 945 to 950, quite an interesting confluence of resistances there. Having to do with metals, Blake already covered gold. Gold still holding the psychologically important 1900 level, so that's one thing going for it. But given the breakdown in silver and the fact that we're now trading below this triangle, I do think, as we've said multiple times, that there is a big chance that we're going to see another leg lower, with 1820 and 1760 being the next downside areas of support. Now, natural gas, since a lot of people are asking, as I said, once it plants through the 205 area, the game completely changed. So I would be looking to buy it if it stabilized above it. But the fact that we sliced through it was, definitely a bad omen. Having said that, I do think that it's not easy for natural gas to make it, and even if it does it will be very, very short-lived below these $155 support area. So, the lower we go and the more we approach that area, the risk reward becomes very appealing once again. Now, we talked yesterday about the possibility of crude oil turning lower, accompanying the move we've seen in stocks, as it did happen. But I have to admit that we're seeing clearly a divergence here. I mean, it's been performing better than stocks, so the correlation, it's not exactly perfect. Obviously, if we see more weakness in stock prices, I do believe that inevitably crude oil will produce one lower low before it can, resume its move higher, which I do think that eventually it will. Especially priced in dollars, I do think that crude oil, despite all the reduction in demand, due to economic slowdown, I think that inevitably it's going to be trading higher once again. So I am viewing this pullback as corrective, but as usually with corrections, it's not easy to predict exactly how they're going to unfold. So you need to give it a little bit more time. Now, having to do with silver, we already covered that with Stelios. Just to say, $23 is the first area of interest below where we are. So before we get to the 21 level that Stelios mentioned, for me, 23 is an interesting area of support to watch. So I would be focusing there first. Platinum, back to the 875 level. What's this one? We know that it's an important area of support. Something that is peculiar is the fact that copper, despite the turn lower in risk, refuses to break through this ascending channel. We've had a huge, consistent, it's not explosive, but it's strong enough and consistent rally from the low that we found in March, just below $2, to where we currently are above $3. As you see, this channel, especially its trend line support, has been holding up like a champ. Worth noting, though, that we've now had a prolonged period of RSI divergence. You can see that RSI, in essence, peaked in the middle of July. We've currently passed the middle of September, and we're still seeing lower lows in the RSI as momentum seems to be slowing. So I do think that inevitably, sooner rather than later, copper is going to produce some type of a corrective move lower. So I do think that the risk reward does not in any way favor anymore being long. I do think, though, that it is very likely that whatever move comes out of breaking through this channel will prove to be corrective. For example, I think $2.7, quite an interesting area. The 200 DMA is also converging to that level. So perhaps until we break through and we make it back to 270, the 200 DMA is going to be exactly in that zone. Just throwing a level there that looks appealing to me. Although, as I said, it's too early because we don't even have a legitimate technical breakdown yet. I do think, though, that it's not going to take long before it happens. There was somebody I saw earlier that was asking about the Dow Jones. Not really anything different with the Dow Jones having to do with the rest of the indices. There is, of course, the divergence that oppositely from the NASDAQ and the S&P, the Dow Jones and the Russell, here's the Russell, they never produced a higher high. So they never produced a higher high from the February all-time high that we had. So that's definitely an interesting divergence. The reason of why that happened is more than obvious. The Dow Jones is a lot less tech heavy as an index, and we do know that the brand of the move higher was created and was pulled by the big 4, 5, 6 tech names that kept rallying higher, irrespective of all the divergences and the breadth of the market, worsening by the day. So that's one main reason. Now, is this like a reliable divergence that actually shows that we've peaked in the other indices without the Dow Jones and the Russell confirming a higher high at all? I think it's too early to call. So far, the move lower in the Dow Jones channels very nicely. So as long as it's contained within this channel, I have no reason to believe that it's impulsive. I will start thinking about that possibility. It's nice to draw a channel when you start having a pullback, because as long as this holds, that the move is corrective. But if at some point you see like a vertical move slicing through this channel, then you have every reason to start considering that something different is taking place here. But until that happens, and especially ahead of the elections, I would be a lot more conservative in trying to call a top. I mean, any political party, any politicians ahead of the elections would throw everything they had at it. I'm pretty sure that soon enough, we're 6 weeks away from the elections. I'm pretty sure that on a daily basis, we'll start having, headlines. Here's the vaccine is coming, it's going to be distributed like in 4 weeks, something with China, something in, with taxes. I mean, they'll throw everything at it. And, as long as the market is still in buy the dip mode, indoctrinated after like 12 years of extremely easy monetary policy and long-term bears being punished almost on a monthly basis. I think these type of headlines,
yeah,
these type of headlines can, in essence, be and prove to be very effective. So, although I see every argument, and I've said many times that this market is priced beyond perfection. It's priced at ridiculous levels. We see on a daily basis, clearly bubble stocks blow up, like Tesla. Yesterday, today, I'm seeing about the NanoX, which another bubble. I mean, it was like 3 times the price a few days ago. It's now been cut in 1/3 or whatever. I mean, this is an environment that creates bubbles. We know that. There's no question about it. So,
hey, Steve.
Yeah.
No, go ahead.
As long as we remain in this environment, and I'll wrap it up, Dale. I said
no,
that.
okay. Well, I mean, I have a good question.
Yeah, go ahead.
From Grish Shankar. Hi, Dale. I'm from India. I was wondering, does your subscription cover USD INR and Euro INR? We get a lot of people from India coming in here. Just a suggestion that maybe we considered one more instrument.
Yeah, we can add USD INR.
Because haven't you noticed a lot of questions
Euro
for
INR,
Nifty?
but our friend needs to keep in mind that people can ask about any instrument they want in the chat room.
Right. But he was asking if our subscription covered it.
No, it's not in the 30 instruments, but we can add it overnight, literally. I mean,
yeah. So
we've built the system in a way that we can add or remove financial markets that we cover literally in a minute.
Anyway, just something to consider, since I've noticed our audience is always asking for.
No, that's a valid point, Dale. That's a valid point.
All right, buddy.
Oh, who do we have today for an interview?
We have Mike Larson. No, we don't have Mike Larson. Michael Larson. We have the real Mike Larson.
Mike Larson. Okay.
Michael Larson's going to talk about the solvency issues that we're going to be facing, and it's a return interview. So, Mike, I'm going to get you all set up here.
Pretty sure if his specialty is solvency issues, he's going to have a lot of work ahead of him in the years to follow.
Yeah. Yeah. So let me just get you set up here.
Okay.
After having zombified.
Welcome back. Welcome back, Michael.
Hi, how are you? Can you hear me okay?
Hey.
Yeah.
Yes, loud and clear.
Perfect. Excellent.
So when Steve stops sharing the screen, you'll be able to, Michael.
There we go.
Alrighty. Let's get that going.
So it's great to have an optimistic guy like you, and with what's going on in our world. And before we get going, Mike, wasn't there a date that you talked about in your last interview? Some vote. It may have been in Italy in September, or maybe it was August. It was going to have major implications for the euro.
That might have been a different guest. I'm not sure. I was more focused. Yeah.
All right,
I know you have a lot of us on, so.
Okay. So, all right. Interesting bond formation here. What are you thinking? That there's another push to new highs in bonds?
Well, what's been really interesting to me, and you look at the recent pullback we've seen in corners of the stock market, particularly dramatically overbought and overowned technology. We've seen the dollar index kind of try and find its footing after obviously a long period of selling off. Things like the Japanese yen starting to tick up, and volatility look like it's carving out a little bit of a attempted low here. A lot of things seem to be coming together to suggest that we've gotten to the point where monetary policy essentially has exhausted itself, and we're at the point where if we don't get fiscal and don't get fiscal before too long, the markets are going to have a real issue, because they're going to finally be accepting, we've pushed asset valuations as much as we can. Wall Street's gotten its benefits out of what the Fed's been doing. Yes, sir.
Just a question. Sorry to interrupt.
Sure.
You know something? We've talked a lot about, and they talk a lot about fiscal policy. And my point about it is that there is no more any difference between fiscal and monetary policy. Yes, the delivery method is completely different, but in essence, having all countries being over indebted, any type of fiscal intervention needs to be monetized 100%. So in essence, how different is it, right?
Sure. I think it's different in terms of what it impacts and how it gets traded.
Yeah, it's the delivery method. Yes.
Yeah, and I think that if we had aggressive fiscal or traditional fiscal policy and less aggressive monetary, I think you'd see in the markets, you'd see the tilt between trading Wall Street beneficiary type instruments and Main Street beneficiary instruments change quite a bit. I mean, if you look at, for example, from the March low through a couple months ago, what kinds of stocks and what kinds of sectors were doing very well. It was all the stuff that was sort of re-inflationary. It was, you saw the big rally and things that were completely beaten down, cruise lines and financials and retail and those kinds of things. You got when fiscal aid was being thrown at the unemployed, when you were mailing out stimulus checks and so on, you tended to see a nice bounce rally, whatever you want to call it, in those names. But as that impulse has kind of faded, it's been up until a couple weeks ago or a few days ago, it's been the growth. It's been the low interest rate forever, weak growth, but secular demand supports tech and so on trade that's been evident in all the markets. So it really changes the character of what's going up the most, what's not, what's struggling, and what's.
It's who gets the money.
Yeah. So
right? Is it the banks or is it the people?
The only problem being is that, unfortunately, with balance sheets, country balance sheets being what they are, it is impossible to have fiscal stimulus without having monetary stimulus run.
The Fed buying the.
Yeah, exactly. Run at full capacity, because there is no fiscal space to actually allocate this type of resources without completely destroying bond prices if there isn't a central bank buying them.
Yeah. I mean, no, I agree with you. I do agree with you there, and I think that we're in an environment where, again, where the impulse, the benefits, the recovery money that was thrown at the economy is clearly starting to run out here. And you guys were earlier talking about the political environment, and well, with the election coming up, isn't the Trump administration or Congress going to try and push something through here to help? And it's kind of funny to me, because I think what we've seen via extremely aggressive monetary policy, because that has sort of neutered the market reaction function, the ability of markets to panic and therefore force fiscal action. The Fed's out there every day begging for fiscal action. A lot of, Janet Yellen wrote her op-ed, whatever, a few weeks ago in the Wall Street Journal and so on, asking for fiscal. But the Fed itself, by neutering that volatility and that forcing mechanism, is making fiscal action less likely. So it's sort of this ironic situation where
we needed that. We needed more pressure on the market.
By the way, good thing that the Federal Reserve was created to be independent.
Independent. I'm going to put quotation marks around that.
Yeah, a lot of them actually.
I wanted to ask you something, Mike. I've been watching this sell-off, and I keep an eye on the yields and TLT. And I've noticed the past few weeks with weakness in the market, there's been no bid in TLT or yields coming down much. Does that bother you, being kind of a bomb bull, that we really haven't had the kind of response that we would normally get? It's almost like, a good day in TLT is up a half a point.
No, you're absolutely right. It has been, noticeable in the last again couple of weeks in this, especially because tech. I mean, it's been the sector everybody's in, and it's been getting hit the hardest. You would expect more upside there. What I'm kind of keeping my eye on, again, is that bottoming pattern that seems to be evident maybe in the U.S. dollar, in volatility and so on, and even to some degree in TLT and bond futures. We haven't, broken back out to the upside, but it seems a lot of these instruments are sort of, making that little rounded bottom. You're getting a little bit of this, this kind of pattern here where the previous sell-off is being, reversed, what have you. And I'm watching to see if we can get that. I mean, I truly think that, all this hoopla about Powell and switching to an average 2 inflation target when you couldn't even hit a straightforward 2 target for 10 plus years during the longest U.S. economic expansion in history. I think we're at an environment where people aren't really buying what the Fed is selling anymore in terms of its ability to create inflation, given the tools it's using. So what I'm very closely watching for is a potential upside breakout in bonds. If we don't get it, then that's going to be worrisome for the longer term. But, I've been an advocate of just staying long treasuries and riding the curve towards zero in the longer term, simply because I see a lot of similarities in terms of what our economy faces and for a longer term future versus what we've seen in Japan and Europe already.
Okay. Do you look for any kind of correlation? There's been one, how correlations are, Mike. Sometimes they disconnect from each other. But do you follow what happens in U.S. dollar yen as it, connects up with yields?
Yeah, I do. And that's kind of why we've seen this little move higher in yen futures and so on recently. It sort of caught my interest last week. I put something on Twitter just noticing that when we've seen this happen in the past, it tends to lead to some treasury buying, or tends to be a signal we might see some treasury buying, a rally in volatility and so on. And we've started to see that. So I'm kind of curious if that's going to continue and whether or not this move gains a little bit of momentum. So it's been one of the other things, again, sort of in a cross-market standpoint, that's kept me willing to stay long bonds here, to see how things unfold.
Because I'm thinking that we may have had an important possible turning point. You have you're looking at the futures. Where we took out that high from a couple of months ago and we're back underneath it. What would be your view if U.S. dollar yen in futures started heading down again? Would that give you pause for your bullish bias in bonds?
Yes, it would. I mean, I think that's definitely something that I am watching here. It is, again, as you mentioned, a little modestly concerning. We're not seeing more oomph to the upside here in bonds, given what's happening in other markets. So yeah, I mean, I'm not aggressively long, jumping in with both hands kind of thing here. But I do still have that long bias, and nothing that I've seen has really changed that. Again, from sort of intermediate to long-term perspective. Yeah,
watch the end, buddy. All right. So, what are you seeing? You have the bonds up here. Are you starting to take into, or are you a believer that it matters who wins the White House in November?
I try to be as apolitical as I can, because obviously I have my own feeling about politics. But when it comes to the markets, I try and keep check that stuff at the door. But in terms of a market impact, clearly I think if it was a strong Biden win and he's able to really muscle Congress behind the idea of fiscal stimulus, aggressive fiscal stimulus, then that would be more of a game changer, I think here. I don't really see that happening again, because whether it goes, regardless of the election results, if you go back to the history of TARP, or if you go back to even this March and you look at what catalyzes and inspires Congress to get off its keister and implement policy.
Crisis.
It's a crisis, right? And
that doesn't even work anymore.
Yeah, and so you look at all the money that was thrown at the economy in March. It was happening because the Dow was going down 700-800 points every day, or what have you. You go back to the TARP vote, and what happened? The first vote fails, the market tanks
Right.
8%, and then they turn around and voted in favor 2 days later. Without that mechanism, again, and I don't know that the election results in and of themselves are going to deliver that kind of market volatility, because whether you're talking about a Biden administration or another 4 years of Trump, both of them are putting a ton of pressure on the Fed to continually be easy, continue to support asset prices, and that's not going to change, in my opinion, regardless of who wins. So, unless the markets take control, unless Powell sort of loses that ability to, use his words to coax asset prices higher, we're not going to get that forcing mechanism that gives us aggressive fiscal.
Okay. So besides bonds, what's on your radar here?
We've talked, I think the last time we spoke, and in longer term, I've been a big precious metals bull since late 2018. Obviously, we've seen, that market consolidate for a number of weeks now, whether it's gold, silver, and so on. And I think, we're still holding levels here that are pretty significant. And I think longer term, I haven't really seen that bullish environment change. Again, it goes back to kind of how the Fed is going to try and get us out of this. It goes back to what's going to happen with interest rates. I mean, I kind of jokingly call it ZERP forever, with quotation marks around forever, but that's essentially what the Fed's locked us into. And if you look at the Euro-dollar futures market and so on, nobody's expecting, anything to really happen at the short end for years and years, or not much at all. And I think, if that sort of Japan, Europe thesis is accurate, then we're not going to be raising rates until a year that starts with the digits 203, if that. So in that case, you don't have competition coming from the interest rate markets for metals. You still have issues of what I call a need for chaos insurance or volatility insurance. People are finding it in metals, and all of those kinds of factors, to me, I don't think are going away. So I think if you haven't been involved in the metals market, this is a pretty good chance to get on board. You have seen that consolidation, but I think that the overall long-term picture still looks
by
solid.
Weakness in metals, you think that there's a shot we pull back to your first blue line, a shade under 1800?
Yeah, I mean, I think that's kind of, in my opinion, that's sort of a worst case short to intermediate term pullback. I mean, we're finding support in this area here, high 1800s or so. It's just like with bonds. I mean, it does bear watching. I wouldn't go crazy, adding long positions here, because you do want to see the character of this correction and whether it does find support. But again, that bias, I guess, longer term, I haven't seen anything to change that approach there.
You're a very fundamental guy, and I understand correlations just because I watch how market moves. What is it behind a weaker yen that could put a ceiling on gold and put a ceiling on bonds? Because if I'm right about the yen, there could be more downside in gold as well. If, I'm talking about the other way around, the way we trade cash, it's US dollar yen, not yen US dollar. And I know it's very early, but I can build a case for a 120 yen, which I don't think would be bullish, which really, and I don't know, the other thing is, why are people assuming lower rates forever just because Powell says it? If you look at the 10-year yield chart, it's so neutral. It doesn't look bearish to me. It just looks like a guy in a coma. And maybe, Mike, we rally and take out that green moving average you have at 97 and head up towards, 120, 140, maybe 2%. How can that happen if the Fed is saying we're not even thinking about raising interest rates?
I think if the market was truly convinced that real economy inflation was coming back, not the asset inflation that we've had as a result of monetary policy and so on, I think if the bond market was truly believing in that thesis and thought that we can, in fact, reinflate effectively, then you're absolutely right. Yields would be going higher. But I mean, I look at what's happening here as not just reflective of policy, but also the bond market just not believing it's going to work. Again, of course, the central banks, whether it's the Fed or overseas central banks, have much more power or control or a tighter grip on the bond markets than they have in many, many years. But still, we all know from history that the bond market eventually is going to win that battle if there's a reason to. If there was panic about real economy inflation, a lot of this stuff working, people would be selling bonds. Institutional investors would be selling them. Foreign investors would be selling them, and we'd see that reflected in yields. I think the sort of coma that's going on in terms of interest rates is reflective of just the belief that we're going to be in this Japan/Europe environment for quite some time. So, I think if anything, and especially if you look at, for example, the action in the financials in the last few days, I mean, sharp breakdowns in there. And I know people are going to say, oh, it's all this headlines about these FinCEN reports on money laundering and so on. But, to me, that's trying to, I don't know, just overthink it.
Trying to explain something that's been, already weak.
Yeah,
right?
I mean, and again, I could just cycle through these charts. I mean, there's companies like Wells Fargo that are sort of like the American version of Deutsche Bank, but even the big name brokers and banks and so on, the charts don't look all that good either. So I think that is reflective of the idea that we're going to be in this ZERP environment for a long time, and banks aren't going to have that that yield curve, those fatter net interest margins to play with. So,
well. Can't there be one other reason for yields to go up besides inflation, like too much supply, not enough demand, and a weaker currency?
Sure. I mean, Martin Weiss and I obviously have talked a lot about, what he saw firsthand in the late 70s, early 80s, and, bond auctions being basically boycotted and the Treasury having to go hat in hand and nobody stepping up to buy. So we know that dynamic can come into play. What I see, though, again, is if I'm sort of using that template in my head of thinking about what's happened longer term in Japan and Europe and so on.
Yeah.
I mean, Japan's, one of the issues with higher debt loads driving interest rates substantially higher, unless there's a pure buyer's strike a la 1980 or 1981, that kind of environment. In general, all this debt that we keep issuing is ultimately disinflationary when you think about it. I mean, if you have companies and individuals that are adding so much, have historically been building up the amount of debt they have, it takes a smaller and smaller increase in interest rates before it breaks the economy. I mean, one of the key reasons the Fed funds has continued to top out at a lower and lower level in each economic cycle since the early 1980s is that debt levels have spiraled higher. So, I always look at it as people can think of like the idea of an adjustable rate mortgage, right? If you have a $100,000 adjustable rate mortgage and interest rates go up 50 basis points, you probably don't even really notice your payment, right? If you have a $500,000 adjustable rate mortgage because house prices are so much more expensive or you have so much more debt on your balance sheet and so on, you notice a 50 basis point increase in terms of the impact on your budget. And that's kind of where we're at overall. And again, that sort of disinflationary impact of all that debt, to me, argues more for a Japan situation, if anything.
Because it doesn't go into anything productive. It's just servicing the debt.
Correct. You have to dedicate more and more.
Yeah,
exactly. You have to dedicate. The more debt you have, whether you're a company or individual or whatever, the more of your monthly cash flow and income you have to dedicate to debt service. And again, and that helps suppress interest rates or drive them lower, because if interest rates go up by a smaller amount amortized over a much larger amount of debt, guess what? It breaks your budget at a lower level of rates. So,
okay. Anything else you wanted to share with us today, Mike?
No, I would keep a close eye on on equities here, and especially on the NASDAQ. I mean, that's not necessarily any wonderful or anything that other people aren't also talking about, but I think it's very interesting that for the first time in a long time, we are seeing loss of momentum. We are seeing we've seen so many of these junky IPOs dumped on the market. We've seen so much momentum in a handful of technology names. We've seen ratios of growth to value get stretched to levels I haven't seen, and the numbers show you haven't really seen since the peak of the dot-com bubble. So it doesn't mean this is it. It doesn't mean that necessarily we're going to just crash from here. But it is noteworthy to see that all these things are extremely stretched, and sort of everybody's in the pool on that part of the market. So I'm watching closely the character of this bounce we've seen over the last 36 hours or so. is it going to gain momentum, or is this going to be the second sort of failed bounce that we have after a huge run up? And if that's the case, if people are no longer sort of buying Powell, buying tech, that this very crowded trade is continuing, it's going to be a sign that maybe something bigger is afoot here.
Okay, Mike, a real nice overview of risk and bonds and yields and precious metals. What's the best way for people to follow your excellent work?
Sure. Anybody can go to our website for my firm, Weiss Ratings. It's www.weissratings.com. I write a weekly column that's in the rotation every Wednesday that they can sign up to get there for free, or they can follow. I try and be as pithy and whatever, depending on how many cups of coffee I've had on Twitter. So if people want to follow me for sort of shorter and quicker tidbits about what's going on in the markets, they can follow me at Real Mike Larson.
Mike, it was real having you, buddy.
Awesome.
Thanks so much for being with us and coming in and sharing your views. And I respect your opinion. So thank you, my trading warrior brother. Good luck going into the fall trading season. I hope you have a great fall, you and all your subscribers, and that your words help and aid and edify people like they did today here.
Thank you. Really enjoyed it.
Thank you, Mike. All right, everyone, that's a wrap on Turnaround Tuesday. We'll see everyone tomorrow. Good hunting, and remember, don't just count your bonds, your bullion, or your babes. Count your blessings. Talk to you guys later. See you tomorrow. Adios. You're welcome, Richard, Sam, Didier, DJ. See my trading warrior brothers and sisters tomorrow. Adios.